Welcome to the Deep Dive. Today, we're embarking on, well, a really in-depth exploration of a true titan in the world of finance. A book that hasn't just guided investors, but has fundamentally reshaped how we approach wealth.
Absolutely.
We're talking about Benjamin Graham's monumental work, The Intelligent Investor.
A classic.
Originally published way back in 1949, which is amazing in itself. And it's astonishingly still relevant, especially with the latest revised edition. That one features invaluable commentary by Jason Zweig.
Right. Zweig's updates are crucial for connecting it to today.
And this isn't just, a finance book. It's widely considered the definitive guide on value investing.
That's the term you hear constantly associated with it, value investing.
And when Warren Buffett, arguably the greatest investor of our time, calls it by far the best book on investing ever written. Well,
you pay attention. That's quite the endorsement.
Exactly. So our mission today is to really extract the most crucial nuggets from this timeless classic. We want to offer you a shortcut, sort of, to truly understanding its core philosophy for managing risk, decoding market behavior, and maybe the hardest part.
Mastering your own psychology.
Precisely. Mastering yourself when it comes to your money. So let's jump right in.
Okay. Well, Graham sets a really powerful tone right from the start. He draws this clear, fundamental distinction that, honestly, a lot of people still get wrong.
Which is?
The difference between investing and speculating. For an intelligent investor, understanding this line isn't just academic. It's absolutely crucial for your financial health.
Okay, that sounds foundational. Why is that distinction so critical? What does it really mean to be, investing versus speculating in Graham's eyes?
Well, Graham defines investing very specifically. It's an operation that, and this is key, after thorough analysis, promises safety of principal and an adequate return. It's about diligent research, understanding the underlying business you're buying into, and really prioritizing not losing your money.
Okay, analysis, safety, return. Got it.
Speculating, on the other hand, is basically chasing short-term market movements, often without that deep analysis, without the disciplined framework Graham advocates. It's much riskier, obviously, less predictable. It relies on, fleeting price fluctuations rather than the actual intrinsic value of an asset.
So it's not just semantics, it's a whole different approach.
A completely different mindset. The shift happens when you internalize that investing is this disciplined, long-term game with clear rules. Speculating, that's essentially gambling, just maybe with fancier terms.
Right. Okay, so you've made that critical distinction in your mind. You're an investor, not a speculator. How do you then navigate the noise, the chaos of the actual market? Graham gives us this brilliant analogy, right? Mr. Market.
Yes. Mr. Market is fantastic. One of his most powerful ideas.
So walk us through how he operates, because it seems so crucial for coping with those market ups and downs.
It really is brilliant. So imagine you have a business partner. Let's call him Mr. Market. Every single day, without fail, he shows up. And he offers to either buy your share of the business or sell you more of his share.
Okay, the daily quote.
A daily quote. But here's the twist. Mr. Market is incredibly emotional. He's, let's say, moody. When he's feeling overly optimistic, maybe even euphoric, he'll offer you really high prices for your shares, sometimes ridiculously high.
Okay.
But when he's gripped by fear or pessimism, maybe bad news hit, he'll offer to sell you his shares at ridiculously low prices, often far below what the business is actually worth.
So the intelligent investor's job isn't to get caught up in his moods, not to panic when he's panicking or get greedy when he's euphoric.
Exactly. You use his emotional volatility to your advantage. Buy from him when he's freaking out and offering low prices, and maybe consider selling to him when he's overly enthusiastic and offering high prices.
So you're exploiting his moods, not mirroring them.
Precisely. And the real genius here isn't just the opportunity he presents. It's what Mr. Market reveals about you. Graham's insight is that the best investors aren't necessarily the ones with the highest IQs, but the ones who can master themselves when Mr. Market is at his most manic or depressed.
So it's emotional discipline again.
It always comes back to that. You don't let his emotions dictate your decisions. It teaches you to be objective, maybe even contrarian sometimes. You see the daily market noise as an opportunity, not a command.
Okay, building on that idea, not being swayed by Mr. Market, Graham gives us a tool, a shield against irrationality and just bad luck. He calls it the margin of safety.
Yes, the margin of safety. He considered it the cornerstone, really, of intelligent investing.
How does it work? How does it protect you?
Well, Graham used a great analogy. He said the margin of safety is like building a bridge designed to hold 30 tons, but you only plan to drive 10-ton trucks across it.
Ah, okay. Extra capacity.
Exactly. In investing terms, it means buying securities, stocks, or bonds at a significant discount to what you've carefully determined their true value to be, their intrinsic value. This difference, this discount, is your margin of safety. It's a built-in cushion. It protects you if your analysis was a bit off, or if things just go unexpectedly wrong in the market or with the company. It's your safety net.
It gives you room for error.
Plenty of room for error. That's the goal.
So, okay, to apply that margin of safety, you first need to figure out that true worth, that intrinsic value you mentioned. How does Graham suggest an investor figure that out when the market price is bouncing all over the place?
Right. That's the core analytical task. Intrinsic value, for Graham, is determined by the fundamentals, the actual characteristics of the business. Things like its real earnings power, its dividends, the value of its assets on the books, its realistic long-term growth prospects.
So stuff you can actually analyze and measure, not just sentiment?
Exactly. Graham emphasizes that the market price is often very different from this calculated intrinsic value. It gets pushed around by psychology, by speculation, by Mr. Market's moods. The intelligent investor's job, the hard work, is to discern that difference through diligent analysis and then act on it. Buy when the price is well below the value. That creates your margin of safety.
Which brings us back to what you said might be the hardest part, the psychology. Disciplined psychology. Because even if you do the math right, even if you understand margin of safety, your own emotions can just derail everything.
Oh, absolutely. Graham was keenly aware of this. He famously stated, "The investor's chief problem, and even his worst enemy, is likely to be himself."
That's a powerful quote.
It is. And he spends a lot of time warning against these psychological pitfalls, like following the herd just because everyone else is buying or selling, getting swept up in euphoria when the market's booming, thinking it'll go up forever, or conversely, panicking and selling everything at the bottom when things look bleakest.
Right, reacting to the extremes.
Exactly. Overreacting to short-term news, letting one scary headline make you abandon a sound long-term strategy. His point is profound. Rational control, emotional discipline. These are paramount. Without them, even the smartest analysis can lead to terrible decisions.
Okay, so thinking practically then, beyond just picking individual stocks, how does Graham suggest structuring your overall portfolio to manage some of this risk?
Yeah.
And, well, maybe help with the psychology too. Where do things like bonds fit in?
That's a great question. Graham very deliberately recommends holding a portion of your portfolio in high-quality bonds or other stable interest-bearing instruments. He saw this as especially crucial during speculative bubbles, when stocks might seem wildly overpriced.
So bonds act as a kind of anchor.
Exactly. An anchor. They provide stability, reduce overall volatility, and offer downside protection that can counterbalance the swings you inevitably get with stocks. It's a practical strategy. It helps you keep your head when Mr. Market is losing his. It provides both a psychological buffer, knowing not all your money is exposed to stock market swings, and a financial one.
That makes sense. Now, a lot of investing talk today, especially online, it feels like it's all about finding the next explosive growth stock, the next big thing.
Yeah.
Growth at any cost.
Right. The focus on narratives over numbers sometimes.
Yeah. What would Graham say about that mentality? Did he dismiss growth entirely?
He wouldn't dismiss growth, but he'd be very wary of the growth at any cost approach. He'd caution heavily against it. Unlike that mentality, which often chases stories and projections, Graham stresses the supreme importance of real, verifiable earnings and, importantly, sustainable dividend payouts. Things you can actually measure today.
So proof is in the pudding, basically.
Pretty much. He encourages investors to avoid the allure of glamorous or overhyped stocks. The ones with exciting stories but maybe weak financials or crazy valuations. It's about focusing on fundamental value, on proven performance, on businesses generating actual cash, not just fleeting trends or speculative hopes. He wanted you to own a piece of a solid business, not just hold a lottery ticket.
That's a great way to put it. Now, one thing I appreciate about the book is that Graham doesn't just give one set of rules. He recognizes that different people have different goals, different amounts of time.
Right. He tailors the advice. He isn't one size fits all.
So what are these two distinct investor profiles he outlines?
He identifies two main types, the defensive investor and the enterprising investor.
Okay, let's start with the defensive investor. Who is that?
The defensive investor is someone whose primary goals are safety and consistency. They want minimal effort, minimal maintenance. They aren't necessarily trying to beat the market averages. They just want, reasonable, adequate returns while preserving their capital above all else.
And what's the prescription for them?
For the defensive investor, Graham suggests a simple, balanced portfolio. Usually something like high-quality bonds mixed with shares of large, established, financially sound companies' blue-chip stocks. Companies with long track records of profitability and dividends. And crucially, regularly rebalancing that portfolio back to its target allocations, say 50-50 stocks and bonds, regardless of market conditions. Keep it simple, keep it safe.
Okay, straightforward. And the other type, the enterprising investor.
Right, the enterprising investor. This is someone different. This individual is willing and able to put in significant time and effort into managing their portfolio.
So more hands-on.
Much more hands-on. They actively seek out investments that might offer better than average returns. This could involve looking for undervalued stocks the market has overlooked, maybe stocks trading below their liquidation value, or analyzing complex situations like mergers, spin-offs, reorganizations, what Graham called special situations.
But that sounds like it requires a lot more work and skill.
It absolutely does. Graham is very clear. The enterprising approach demands rigorous discipline, deep analysis, a strong understanding of financial statements, and again, that crucial emotional control. It's not for the faint of heart, and definitely not for someone who isn't prepared to do the homework consistently.
It's amazing how a book written, decades ago still feels so relevant. You mentioned Jason Zweig's commentary in the newer editions. How much does that help bridge the gap?
Oh, immensely. Zweig's commentary is invaluable, really. He takes Graham's core, timeless principles and connects them directly to modern events. He'll discuss Graham's ideas on market folly, for instance, and then illustrate them with detailed examples from the dot-com bubble of the late 90s or the 2008 financial crisis.
So he provides the modern context.
Exactly. He doesn't just repeat Graham. He shows how these classic ideas played out or would have helped you navigate the specific challenges and manias of recent market history. It makes the theory incredibly practical and relatable for today's investor.
Okay, so if we had to boil everything down, all these concepts, investing versus speculating, Mr. Market, margin safety, the different investor types, what are the absolute core actionable messages you think someone listening should really walk away with from Graham?
Right. The key takeaways, well, first, maybe paradoxically, your main goal probably shouldn't be trying to beat the market. Focus instead on not losing money permanently. That's foundational.
Preservation first.
Preservation first. Second, stick to your analysis, do the work. And, crucially, resist making decisions based on emotion, fear, or greed. Easier said than done, but vital. Third, always demand a margin of safety in every investment. That buffer is non-negotiable.
No overpay.
Never overpay significantly relative to underlying value. Fourth, understand what you're actually buying. If you don't genuinely comprehend the business, how it makes money, its risks, stay away. Don't invest in things you don't understand.
Circle of confidence.
Precisely. And finally, remember that long-term success usually comes from time in the market, letting your investments compound, not from trying to perfectly time the market's short-term moves. That's mostly a losing game.
Those are powerful. It really feels like the impact of the intelligent investor goes way beyond just finance tactics. It's almost philosophical.
I think that's exactly right. It's not about hot stock tips or get-rich-quick schemes. That's not Graham at all. His brilliance is that the book teaches enduring principles: discipline, patience, rationality. Thinking clearly under pressure. Its message truly is eternally relevant, maybe especially today, in times that often feel very speculative, where the temptation for quick gains is everywhere.
Yeah.
Buffett's high praise isn't hype. It really is a masterclass in how to think about investing and managing your financial life with reason. It gives you a mental framework.
So for you listening right now, maybe you're wondering, is this book actually for me? It sounds old, maybe complicated. Who should read it, and why should you care about this classic from 1949?
Well, I'd say it's essential for beginners who want to build a really solid foundation. Learn the right way to think about investing from the start. Avoid those common, costly mistakes many people make. But it's also invaluable for serious, experienced investors. It's a way to sharpen that rational mindset, reaffirm your core principles, especially when markets get crazy.
A touchstone.
Exactly, a touchstone. Basically, anyone who wants to protect their wealth and grow it patiently, intelligently over the long term will find immense value here. It equips you with the mental tools, the mindset to navigate any market condition, not just chase the latest fad.
I couldn't agree more. My final verdict: The Intelligent Investor is a resounding 10-10. It's simply a must-read classic. If you're looking for that timeless wisdom, something that protects you from big mistakes and genuinely sharpens your thinking, this book will be a lifelong companion.
Absolutely. And maybe to leave you with something to think about. If, as Graham suggests, the greatest challenge for an investor really is often themselves, their own emotions, what single concrete habit, something rooted in Graham's philosophy like checking fundamentals before acting, or maybe automating investments to avoid tinkering, could you cultivate, starting today, to better manage your own emotional reactions to the market's inevitable ups and downs?
That's a really powerful question to ponder. A great place to wrap up this deep dive. Thank you for joining us on this exploration of Benjamin Graham's The Intelligent Investor. We'll be back soon with another deep dive into a new stack of sources. Until then, keep digging.